Welcome to another episode of Merill Talks, the channel where we discuss everything from the stock market to global economics and how world events affect your investments. As usual, I have Merill Fund Manager Marc Ellazidi. He has managed money from Switzerland, London and finally Malta for over 2 decades. Welcome, Marc.
Hi, welcome Mike, welcome to the audience.
Our last episode was dedicated to the Bank of Japan's contrarian approach in fiscal policy, considering global easing policies around the world. And we'd like to thank our audience for the feedback on that video. It has done well and we're happy to see what we received. If you wish to receive further insights, please feel free to join our LinkedIn page and even visit our website, merillfunds.com. Today we will be discussing and exploring the fixed income asset class, contrasting it with equities, and discussing our outlook and strategies for navigating this vital investment landscape. We'll delve into our reactions to recent events, last year's banking stress, and share our positions on high-yield, investment-grade and sovereign fixed income exposure. At Merill, our expertise lies in risk management. Together with Marc, our CIO, will dive deeper into the rationale behind our risk management approach, which has consistently positioned us as one of the top funds in terms of risk-adjusted performance for several years. To get started with the questions, Marc, last year we saw the situation with Credit Suisse in Europe. We saw specifically the CoCo exposure and how that affected portfolios around the world.
I think it was like a big shake because the 81, finally what happened with Credit Suisse was like a big shake. So far everything was contained from a risk perspective, but a lot of some, I would say, professional investor lost a lot of money. I think it was around $17 billion wipe out with this CoCo, and of course it was creating like really problems, especially for the banks if they have been issuing new CoCo, etc., etc. But I think here our approach on that side, it's really try to avoid this kind of instrument. This instrument for me was always like more related to equity than a bond, and we know also how is the ranking into a balance sheet, and I think it's always very important, especially for the investor, to understand that we start with loans, senior, secure, unsecure, and after we go down and down, subordinate, junior, sub, and after we have some junior sub with contingency, CoCo, and 81. So I think you need to be aware that there is a risk. I mean, what the Swiss government did by pushing US and to wipe out this CoCo, it's to save. Obviously, it's a political decision in the way, because a lot of old people in Switzerland own the stock of Credit Suisse, and they didn't want to touch the stock, which is, like I said, by nature, as we know, CoCo should be here because on the capital and the ranking, and equity is here. But I think it's a political reason, and they say, yes, because you are a professional, so you need to take how to bear the risk. No, I will not comment further on that side, because there is a lot of ongoing the court on that side. So yes, definitely for us it was always an idea of not having CoCo on board, because it's very important that we need to sleep at night and our investors need to sleep at night. So it's very easy to go on CoCo because they offer like really high coupon, but you really need to go into details and see how's the structures, when is the triggers, where's the CET1 ratio of all the banks. So I think it's really taking a lot of time on this, and what I say, don't forget, and that's the message here with the CoCo, you are the bondholders, but you don't have the power of trigger the CoCo, and that's the thing, who is the issuer on that side. So very important, any CoCo you own, you are no power on this, because the issuer has the power, or it could be also an automatic trigger. I hope I answered your question on the CoCos.
Yes, very much, very much. And keeping on the subject of bank failures, we also saw potentially, and I'd like to hear your comments about it, the effects on high yield. So when we talk about the high yield income class, what are we looking at in terms of what the banking crisis caused?
I mean, we could imagine last year with this story of the 81 of Credit Suisse could trigger problem on the high yield. Actually, it was not the case. Quite a surprise, I would say, for the market. But also, what happened in US with Silicon and Signature, these banks who are on the crypto side went into bankruptcy. I think it was contained. The risk was contained. I think in US the risk was clearly contained. But I still have a doubt that the regional bank at the moment are still struggling. When I will say the big four like JP Morgan, Citibank are still doing a good job, or Goldman Sachs. We are at the moment in the earnings season, so we are at the end of July. And clearly, I think so for the moment, the banks are still in good shape, the big banks. Now the regional bank, I have doubt. But that's why I think for us, our visions on the high yield, we try to have a limited exposure, I would say, in US. We prefer Europe on the high yield. It's more diversified for us, and we know better the business. So that's the things. Really, we really like to go into European high yield. So really clearly have a preference on that side.
Understood. So, with regards to the timing of the overall fixed income market, as we know, for many years we've had lower yields. We're in an unprecedented time for at least the recent few years. How can we capitalize on this opportunity?
I think at the moment the investors is quite confused because we have a message coming from the bond market, a message from the equity market, which is completely different. As we know, there is the inversions of the curve, 2 versus 10 or 2 versus 30, and we know, like a lot of people said, it could be bringing recessions, not in 2024, but probably 2025, when we can see even there is some corrections, and the stock market is quite toppish. That's the things, but it still have a bull trend. So we're this is a confusion here. We have a stock market really quite bullish, even if it's toppish in the way the momentum is still quite strong, even volatility. And on the other side, you have the bond market who's telling you, recession is coming, why we have inversions on the curve, more than ever, 2 against 10 and 2 against 30. But I think our vision is, I know the stock market is strong and it can remain strong even it's volatile. The way we approach the things, us in our bond fund, it's like you can put in place some preferred or play the subordinate, and that's the thing. So we are playing the subordinate bonds, which is more I would say, correlated with the equity market. I like to say that we like subordinate on the insurance industry better than the banks. It was always a choice we had. It's a strategic visions we get here to prefer to have, I would say, the subordinate in the insurance sectors. I know, for example, the equivalent we discussed at the beginning of these discussions, the CoCo on the bank sector, but there is the equivalent on the insurance, which is the RT1. But we feel more comfortable maybe to have some RT1 on the insurance side, even if we have just one, I think, or two. That's the only vision we get here. And like I say, I think it's for the fixed income market, it could be the time. I know a lot of people are saying when it's coming, etc. But when you have facing quite a toppish equity market, I think it makes some sense to invest a little bit on the fixed income. And I think you should think about it as a diversifications, especially to mitigate your risk, because I think so far since last year, especially with the AI narrative, semiconductors went to the moon. We know that NVIDIA went to the moon. But it's your perception of the risk could be a little bit different, and you say, yes, it's not so attractive to be in the fixed income space, but maybe you are wrong, because I would say sometimes the less sexy place to invest are probably the most protective one. And I know maybe the narrative is not like, the AI or NVIDIA, this is really, I will say, it's fantastic, everyone like it, etc. And fixed income is like, it's more like for the grandfather. But I think maybe you need to think about it because the time could come very soon on the fixed income side.
So, Marc, any additional or final comments in terms of equity?
Yes, I think that's why everyone is confused at the moment because we are, like I say, we have like a very strong momentum on the stock market, especially the tech one, even the sell-off took place. And on the other side, we have some indicators who are going down, even if the GDP figures have been quite good. But I think the problem now, we are at that point, like there is like the stock market in that side, and the indicators who are slowing, going down. So the spread, the gap here, it's becoming massive. And as we know, this kind of gap, how long it will stay? And that's really the big questions. And if you have some fixed income funds, if you want to increase the sensitivity on the equity part, which is like using the subordinate or the preferred, it's possible. So like I say, you can have a fixed income fund, but having also inside still some fixed income, but with more sensitivity to the equity market. So I think everyone is expecting something's coming, especially we are all nervous until the US elections, I will say, until I mean, based on the poll at the moment, Trump versus Kamala Harris. So that's the thing. So it's maybe good to think and prepare ourselves for this troubled period, which is probably will stay until November and even after. And I think the fixed income, it could be the right asset class on that side. That's why I say us at Merill, we really like it. As you know, we are very conservative, and clearly it's showing on our volatility. I think, like you said, risk management is the core of our business. We really want, as we say, sleep at night, and I think we need to be preventive. Always be preventive. That's why we discuss about the CoCo. We discuss about the subordinate. I would say, on the financial side, banks versus the insurance and what kind of bonds we prefer, and as we say, we really prefer insurance. Same story on the high yield, why we prefer Europe, because it's more diversified and we get more control, more diversified on different area. And like I said, the US high yield is quite highly cyclical, so we prefer to stay a little bit aware of that side. And that's clearly how we see the things. And clearly, again, I think we are doing like really risk management, really the core of our way of managing the money, and we want to keep this way because I think reputation is key.
So, Marc, in comparison to many other funds that operate in similar areas to us, we are in more of the top ranking in terms of volatility, as we've said in risk management. Would you like to explain a bit more on how we do that?
Yes, like I said previously, we try to be very preventive the way we select the fixed income, and if we want to increase or not the sensitivity of our portfolio. But I think this is one thing on the seniority of the debt, but we also actively manage our durations, and we opt now at the moment by selecting. We don't put in place a hedge using futures, because we could do like I would say a macro hedge. We have a preference to go side by side. We have the capacity with treasuries, US treasuries, to adjust the durations we think, and there is a potential. I think at the moment a lot of people are speaking about a bull steepening, which is like the short rate will move in terms of amplitude higher than the long rate, and we think this is the case we are at the moment, and that's why we are managing this way, and we are doing like a macro management, really adjusting the duration this way, because we could opt for the futures, but we prefer to do this way. It's depending how is your view. Sometimes, like I say, we like to segregate the strategic view and the tactical view, and for the moment I think we want to be strategic on the duration side, we don't want to use future to be very tactical or to hedge this part. And of course, like I said, the seniority and the rank to increase or not the sensitivity to the stock market. Like I said, the momentum is still very strong, and we notice this. But like I say, also we had the sell-off on the tech side because of a tweet of Trump making comment about Taiwan, and as we know, the supply chain, Taiwan semiconductors and etc., where they position, and we know the tensions in these things. So I think going forward, we have a lot of macro to follow. A lot of things are going on, and especially in US, we will see of the elections and who will take who will be the next president of the United States, and I think it will create some interesting things. And that's why I say I think fixed income, when you have a strategic visions and you invest, it's here to stay. Now, when you have the equity on your hand, you need to be more in alert, because overnight the things can change. So I think also fixed income, it's bring you stability in your allocations, and that's why we really like this asset class. And even me, for the years I'm managing, because I used to manage commodity funds, which is like the fast one at the end of the spectrum. And of course, fixed income is at the other side. So I used to manage like commodities, which is we used to rotate on a weekly basis based on our convictions. And fixed income, obviously, you're not managing so fast. But I think it's good. It gives you a good idea how to be proactive, and that's why having a strategic visions, and that's why we didn't change our strategic visions. And like I say, we've been cautious on the CoCo and never attract by the high coupon. I think clearly here, and in conclusion here, is like really risk management. It's the core of our visions here, and we will continue on these directions. And hopefully, I'm sure you will like it, what we do, and you will like our performance and also our volatility.
Thank you very much for joining us in today's video. Do not forget to check us out on LinkedIn and even our website, merillfunds.com. We wish the best and hope to see you for the next video. Thank you.
Thank you very much.